welcome to Borosil Q2 FY26 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manan Goyal from ICICI Securities. Thank you, and over to you, sir.
Thank you, Nitish. On behalf of ICICI Securities, we welcome you all to Q2 FY26 result conference call of Borosil Limited. We have with us today senior management represented by Mr. Srivar Kheruka, Managing Director and CEO, Mr. Rajesh Kumar Chaudhary, Whole-Time Director, Mr. Anand Sultania, CFO, Mr. Rituraj Sharma, President, Consumer Products, and Mr. Balesh Talpade, Vice President, Investor Relations. Now, I hand over the call to the management for initial comments on the quarterly performance. Then we will open the floor for Q&A session. Thank you, and over to you, Srivar, sir.
Okay, so thank you to ICICI Securities for arranging this call. Good afternoon to every one of you. The Borosil team is delighted to be communicating with you once again. I'm pleased to inform you all that Borosil Limited's board has approved the financial results for Q2 and H1 FY26 during our meeting on 7th November 2025. We have submitted our results and an updated presentation to the stock exchanges, and they're also available on our company's website for your review. I'm pleased to share that Borosil Limited delivered an impressive performance in H1 FY26 with consolidated revenues from operations at INR 573 crores compared to INR 499.5 crores in the same period last year. This translates to a 14.7% year-on-year growth. Despite a challenging Q1, this half-yearly growth highlights the resilience of our business model, very strong execution capabilities, and the continued trust of our customers, as well as the hard work of our employees. In order to just highlight one point, we do realize that Diwali this year is earlier than the prior period, and therefore the comparison to last year is not exactly like to like. In H1 FY26, the company recorded an operating EBITDA before investment income and one-time incomes of INR 90.1 crores compared to INR 82.2 crores in H1 FY25, marking a 9.5% Y-over-Y increase. This improvement reflects a continued emphasis on operational efficiency and sustainable growth. The operating EBITDA margin was slightly lower at 16.1% compared to 16.8% in the previous year. Other operating income for the first half of 26 includes INR 12.1 crores from shared service support income compared to INR 8.4 crores in the same period last year, with the related expenses reflected under total expenses. PBT for the period was INR 53.9 crores, up from INR 38.8 crores in the previous year. H1 FY26 includes a one-time stamp duty expense provision reversal relating to demerger of INR 7.2 crores, which is shown under the head other income, and also includes one-time expenses of INR 1.8 crores towards professional fees for assignment. The net impact of one-time items is INR 5.4 crores. During the same period, depreciation increased by INR 4.3 crores, while finance costs declined by INR 5.2 crores, primarily due to debt repayment. As a result, PAT rose from INR 27.6 crores in H1 FY25 to INR 40.1 crores in H1 FY26, reflecting a strong 45% year-over-year growth. As on 30th September 25, Borosil Limited has a net debt of INR 4.5 crores. So now let's take a look into the categorized performance behind the numbers for H1 FY26. Our consumer division continued to grow across both glassware and non-glassware segments under the Borosil brand, alongside our opalware range under the Lara brand. Coming to Lara first, the Lara opalware segment recorded sales of INR 195.4 crores in H1 FY26 compared to INR 181.3 crores in the same period last year, which is a growth of 7.8% Y-o-Y. In our glassware segment, which includes microwavables, servingware, glass tumblers, lunch boxes, and storage solutions, we recorded an impressive Y-o-Y growth of 27.4% in H1 FY26. Revenue stood at INR 148.6 crores compared to INR 116.7 crores in H1 FY25, reflecting our demand across key product categories. The non-glassware segment, encompassing a wide range of small home appliances, insulated bottles and flasks, ware and other kitchen essentials, performed strongly, posting a 12.4% increase in revenue. Turnover for this segment reached INR 216.6 crores in H1 FY26 compared to INR 192.8 crores in the corresponding period last year. BIS compliance requirements affected our Hydra bottle sales, as some of the channels are only accepting BIS certified steel products. Our team has recognized these headwinds and is actively reshaping the overall strategy to mitigate the impact. It is pertinent to note that the growth in non-glassware was in spite of a substantial degrowth in the category of Hydra. As a part of this, during the quarter, our board approved a revised project scope for our upcoming manufacturing facility in Rajasthan through our wholly owned subsidiary, Styleness India Limited. The project will now include 3 double-wall production lines for vacuum-insulated steel flasks, bottles and containers, with an estimated capacity of 3.6 million units per year and with an estimated capex of INR 65 crores. Estimated commercial production dates from 2 double-wall lines is by the end of this financial year, that's Q4 FY26, and that's from the 3rd double-wall line by the end of Q1 FY27, subject to receipt of necessary approvals. This INR 65 crore investment will be financed through a mix of equity, debt, and internal accruals. The expansion reinforces our commitment to Make in India and will enhance our compliance, that is BIS compliance, and strengthens our supply chain resilience by reducing dependence on imports. Alongside a strong revenue performance, H1 FY26 saw the company implement several cost control initiatives to enhance operating efficiency. We will continue to keep a close watch on expenses, particularly advertising and sales promotion, which remained at INR 38.4 crores in H1 FY25, which was approximately the same as the same period last year. In addition, power and fuel costs declined from INR 42.3 crores to INR 36.9 crores over the same period, reflecting our continued focus on prudent cost management. We were also honored to be named the most trusted consumer service provider in the consumer appliances sector at the India CX Summit and Awards 2025 by Cinex Group. This recognition proves our unwavering commitment to customer satisfaction and our focus on delivering experiences that embody the same quality and reliability as our products. Between FY18 and FY25, our revenues have been growing at a CAGR of 23.5%, while EBITDA expanded at a 34.3% CAGR. Since acquiring Lara in 2016, its revenues have risen from INR 48 crores to INR 384 crores in FY25, delivering a 26% CAGR. Likewise, our non-glassware portfolio has grown from INR 23 crores in FY17 to INR 453 crores in FY25, reflecting an exceptional 45% CAGR, which shows clear evidence of our ability to deliver sustained growth and value creation. We remain focused on the long term, and the outlook for our categories is strong. India's per capita GDP has risen from about INR 1.1 lakh in FY22 to nearly INR 1.4 lakh projected for FY26, with per capita consumption expected to approach $4,000. As income rise, spending on lifestyle and home product grows, and with a premium yet accessible positioning, Borosil is well placed to capture this expanding demand. India's brown goods market, which includes kitchen and home appliances, is expanding rapidly. Valued at about $5 billion in FY24, is projected to reach $9 billion by FY30, growing around 10% annually. This surge is led by rising demand for kitchen-focused appliances like oven toaster grills, choppers, mixers, and sandwich makers, categories that align well with evolving consumer preference for convenience, efficiency, and modern design. In recent years, India has seen a clear shift towards health and sustainability, creating strong tailwinds for Borosil. The $50 billion health and wellness market is projected to reach $90 billion by FY30, also growing at 10% CAGR. Consumers are moving towards toxin-free durable materials and away from plastic due to rising health concerns, regulatory bans, as well as sustainability concerns. This shift squarely aligns with Borosil's focus on safe, eco-friendly products, which include glassware, steel, and opalware. We see strong potential in INR's 4,000 crore lunchbox market, where consumers are increasingly seeking safer, microwave-friendly, and sustainable options. This is where Borosil stands apart. Our premium glass lunchboxes combine durability, leak-proof design, and microwave compatibility in a stylish, long-lasting product, one that has become a substantial part of our portfolio. A key pillar of Borosil's long-term growth strategy is our strong commitment to Make in India. We operate one of India's largest opalware capacities at 84 tons per day, along with a 25 tons per day borosilicate glassware plant that we commissioned last year. Building on this foundation, we are now expanding our manufacturing footprint with a new facility dedicated to producing vacuum-insulated stainless steel bottles, flasks, and containers. Borosil is leading India's move towards healthier, eco-friendly kitchens by replacing plastic with microwavable safe, BPA-free glass and sustainable steel products. As rising incomes and health awareness drive the shift, we are steadily converting plastic users to glassware and opalware. Through aspirational designs, educational marketing, and a focus on hygiene and elegance, Borosil is redefining the modern Indian kitchen. Our strong omni-channel presence across general trade, modern retail, top e-commerce platforms, and expanding B2B and export networks has driven deeper market penetration. With availability in over 24,000 retail outlets, we built a well-diversified revenue base that reaches both urban consumers and rural users. In summary, Borosil's strong brand equity, diversified portfolio, expanding manufacturing base, and omni-channel presence position us well for sustainable growth. With that, I thank you, and I would be happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi, sir. Congrats on a good set of numbers, and thanks for taking my question. So my first question is, if I
Sorry to interrupt, Naitik. Your voice is coming muffled.
Just a second. Is it better now? Hello?
Yes, it is. It is loud and clear. Please go ahead.
Hi, sir. Hi. Thanks for taking our question, and congrats on a good set of numbers. So my first question is, if I look at your 3-4 year period, we have spent almost 550 crores of capex. So I just wanted to know the breakup of this capex and what sort of peak revenue potential do we see from the capex that we have spent already in the past 3 odd years.
Okay. Well, I think I shared this breakup in the past. Offhand, I don't have exact numbers for you. But broadly, most of the capex has been spent for expansion of our opalware glass. We added a second opalware furnace. We added a borosilicate glass furnace, the first one of its type in India. We've done large solar projects to reduce cost of power and fuel, or at least power, and various upgradations in our Jaipur plant. We've put in a lot of new capacity there. So both upstream and downstream. So I would say that's most of the capex. But specific, I think you'll have to go back to some previous conversations such as this and find it. You'll definitely find specific numbers.
Sure, sir. No problem. So just wanted to ask, what sort of peak revenues do we expect we could do from the capex that we have done in the past, including the 60-65 crores of the flask insulated bottles, that we are putting up?
Yeah. So look, peak revenue is, you see, our revenue is not dependent only on our capex. We also buy products from third-party vendors. So I can say that the peak revenue from this capex, including the flask, will be over 1,000 crores. But that doesn't mean we already more than 1,000 crores of revenue. That's because we also buy products from outside. So I would say that you have to take peak revenue with a little. It's only from this capex, not including availability of products from third-party vendors.
Right. So this 550, 600 odd crores, including Flask, can give us 1,000 crore. That's what I want to understand. I'm just talking about this 550 crores. How much revenue can this 550, 600 odd crores?
Yeah, I mean, maybe 900 to 1,000 crores. 900 to 1,000.
Got it. Got it. And sir, along with this, after the 65 crores capex that we do for the bottles, the peak of the capex cycle is behind us, or we do plan on some capex going forward also?
No, you see, our sales have been growing well, and I think the way it looks from the government's perspective is that we are, making it more and more attractive to make in India. And because of that, we will be doing a lot more capex in the future for sure, in maybe different segments, because even our non-glassware segments picked up a lot. So there is scope to do more capex there. But nothing is, finalized here. But I'm sure we'll be doing more and more capex because we see, reasonable growth opportunities ahead in those segments.
Got it, sir. So my last question is, you could provide us the amount of utilization that we are currently at in glassware and opalware?
I would say opalware like 90% plus, and glassware around 80%.
Got it, sir. That's it from my side. Thank you.
Thank you. The next question is from the line of Pranay Roop Chatterjee from Burman Capital Management. Please go ahead.
Hi, good evening. Thank you. Am I audible?
Yes, you're audible.
Yes.
Please go ahead.
Yeah. My first question is on the margins. I was just slightly confused. If I look at it quarter on quarter and YOY, number one, your revenue is much stronger. As you called out, you said Diwali was earlier, so that would have positive impact on your revenue. So revenue is higher. And I am seeing that the mix is also favorable, right? Because both opalware and consumer glassware have done better than your non-glassware. And non-glassware is where it's mostly traded, right? So my question is this a single factor or a combination of factors that you would like to call out which have depressed margins in this quarter?
Yeah. So basically, there's two reasons for reduction in margin. One is that in the non-glassware segment, we've had to start moving substantial volumes from made abroad to made in India. And in the short run, the vendor ecosystem in India is not as efficient as the vendor ecosystem overseas. It will take time because overseas, these vendors have been making products for the last 20, 30 years, and Indian, production has just started. So in the short run, definitely there's pressure on gross margins in the non-glassware segment, which is why I would say the main contributor. The second thing is in the non-glassware itself, we lost a reasonable amount of revenue on this Hydra product category, which was higher margin. So the product mix also has hurt us in non-glassware. So most of this revenue contraction, or rather margins, I mean, it's not a big contraction, frankly, but it's still there. It's coming from, I would say, temporary factors relating to adjustments in supply chain owing to more difficulties in imports and moving to India sourcing. I would say that these are, short term, probably in the next 12 to 18 months. This factor will play out, and as you rightly mentioned, the benefit from higher sales of our own manufactured goods, which was actually quite substantial, but hasn't shown in the numbers this year.
Makes sense.
But if it was like to like, then you'd see I would say 2-3% improvement in our overall EBITDA numbers, percentage wise.
Got it. So, just in case you are willing to answer this question, so in non-glass, which blended EBITDA margin is probably steady state, high single digit, probably when you're purely sourcing, would that be below break even, above break even, low single digit?
No, it's above. It's gone from high single digit to mid single digit, more or less. So there's been a substantial reduction there. It's of course it's definitely beyond break even, and it's like I said, it's a short term phenomenon. I'm not too worried about it because these things will play out in the next couple of years. Yeah.
Perfect. No problem. No, that makes complete sense. Another key question we had, I think a couple of quarters back, and this is something that you had mentioned, is that this is when the BIS was coming into play for flasks, and you had mentioned that we have enough capacity to last us till Diwali. So now we have officially crossed to Diwali. So, and you did mention a statement where you have already lost revenue. So how is it looking like for the rest of the year? I mean, especially Q3, right, before your capacity start coming in. Should we expect a material impact in the next quarter, Q3, because
there is
of
an impact.
last?
So in fact, I thought the impact would be worse, but it's been, I mean, we had stock, we had inventory, but the demand in the market was far higher than our ability to supply that demand. So therefore, we did lose out on potential revenue growth. I mean, just to be clear, we've still grown on 12% in non-glassware. So, but that growth may have been north of 20-25% had we had that inventory. As you rightly mentioned, the inventory is on the lower side now. I think we have enough to last us. Frankly speaking, a couple of channels have already stopped accepting non-BIS goods, which is also impacting sales. So even with the inventory there, some channels are not accepting those goods. So that is also hurting us. But probably from Q4, we'll start seeing some bounce back, and maybe Q1 of next year, we should be back to normal, I would say, output or back normal sales. But yes, there will be some impact. Hard to quantify at the moment.
Got it. No, got it. Great. And just a confirmation on initial remark you made. Probably I'm missing something here, but you said the base is not comparable, right? So last year Diwali was, I think, 28th, 21st. No, last year Diwali was third week of October, and this time it's last week of October, right? So
no,
or
the
it's
other way around. The other
last
way
year
around.
and third week this year.
I think last year was 1st or 2nd November, if I'm not mistaken. It's about 12 days earlier.
Yeah. And this time it was third week of October. So the reason you called it out, is it because you're seeing a YOY dip in the current quarter? Is that the reason? Because 7 days.
That's always, if you see, again, if you look at my Q2 remark last year, it will also have some comment on this, and the Q2 remark the year before will have some. So I'm just calling it out so that, we don't think that these are exactly comparable. There's some impact. I'm not projecting anything for Q3 at all.
Okay. Good. Thanks a lot, and the numbers look great. Thank you.
Thank you.
Thank you. The next question is from the line of Akshat Mehta from Seven Rivers Holding. Please go ahead.
Hello. Thank you, sir, for the opportunity. I had a few questions on the results. So number one is just want to understand on the revenue part, except for, let's say, the month of September, where you see an early impact of Diwali coming in, for August and for, July, on a figurative basis, what kind of, year-on-year growth did you see? I mean, I'm not asking for a specific number, but a trend, so that we can understand where the industry itself is moving, except for the festive season period.
I mean, as I said before, the first quarter was not good. I mean, you know the numbers for the first quarter, right?
Yeah.
So the first quarter was challenging for everybody, and we had, I think, if I'm not mistaken, single-digit kind of growth in the first quarter. This, started changing from, I would say, Q2 onwards, the first half of Q2, and obviously the festive season supercharged it a little bit. We'll have to see now how the rest of the year goes. Hard to predict, because here, actually, there are two factors at play. One is the demand from the market, and the other is our ability to supply specifically one product category, that is Hydra. And that is, muddying the waters a little bit in the short run, because it's hard to predict how it's going to play out. Overall, I would say demand has picked up, from Q1 onwards to Q2 and Q3, and even, and we see, with the GST reduction, I think, although it's not directly impacting our goods at all, but just general consumer sentiment seem to be better than before. So I'm, reasonably bullish on demand going forward. And our short-term issue, which is specific to Borosil, on our ability to supply that demand on the Hydra category, that, will fix itself in the next 2-3 quarters. So overall, I'm quite bullish for the future.
Thank you.
Hello? Yeah.
A reminder to all participants, anyone who wishes to ask a question may press star and one on the touchtone telephone. The next question is from the line of Bhavin Rupani from Investec. Please go ahead.
Yes. Hi, sir. Thank you so much for this opportunity. So first question on small kitchen appliances. So we'll see BIS implementation kicking in from FY2026 onwards. So just wanted to understand what proportion of our non-glassware revenue stands exposed to BIS right now, and if we are still importing it, can we see jump in working capital because of this going into second half?
Yeah, I mean, frankly, the entire non-glassware segment is subject to BIS now with what you just mentioned. So the main drivers were Hydra, which is the vacuum flasks, then appliances, and then steel, the stainless steel. These are the three categories within non-glassware. Now, as it stands, we've also launched gas stoves as a fourth category, but the third and fourth, namely the steel and the gas stoves, when we were already aware that this issue is coming, so we started with only Make in India. So that product won't be impacted at all. And Hydra, which is the biggest category, we've already decided to produce in India, and that's en route. So appliances will be impacted, but seeing this coming, of course, we knew this was coming from some time ago. Already, roughly 50% of our appliance revenues are made in India, and this number will go 70 to 80% in the next 12 months. So we are seeing good traction there for our local sourcing. It takes some time, and like I said, there's a margin pressure on that, but overall, I think we're on the right track. So there will be some working capital impact, although, frankly speaking, it will not be that material because last year our inventory went up because we had a higher inventory of Hydra, which has now come down, and that will be replaced by BIS inventory of appliances. So net from last year, I don't think there will be much impact, but I'd expected working capital to reduce this year, which may not happen.
So net, can one say that our import contribution right now is 20-25% of total non-glassware revenue as of now?
Of total revenues?
Non-glassware revenue.
No, it may be slightly higher. It may be slightly higher than that, but I think by the end of this financial year, it will reduce to even lower than that, so maybe 10-15%. Right now, because we've stocked up, it may be slightly higher than that.
Got it. Also, sir, you mentioned about expansion in other categories going ahead in non-glassware. So, what is the priority list? Any indicative list should also be fine over here.
I mean, look, obviously, whatever we sell more, we'll manufacture. Whatever we sell more, there's a Venn diagram. One is what we sell, and the other is what we aren't able to source at a competitive cost, which we believe we can manufacture at a better quality and cost. So the intersection of those two diagrams will give you what we are going to make. But I don't have an answer for you at the moment.
All right. And the capex we'll start it from FY27, 28 onwards? Any indicative time?
From FY27, not even 28. But like I said, I don't want to get into specifics because these are just under consideration and haven't been approved by a board yet. So we'll do it. We'll cross the bridge when we come to it.
All right. And one more question on Hydra. So this is the first time that we are doing a steel product in-house. So what is your sense on ramp up and time to full utilization? And what would be the peak revenue as well as EBITDA for this category?
See, peak revenue, I can say, peak revenue from our production, I think would be close or just north of 200 crores. However, when we can reach there, our effort obviously is to get there as quickly as possible. I don't want to put a number or a date out there because it's like you said, it's the first time. There are many known unknowns which we will solve for, but there are also many unknown unknowns which are hard to kind of predict. So I don't want to give a number or a date, but I think we followed the process. We've recruited good talent. We've done everything by the book. So I see no reason why this should take more than any other plant would take. So yeah, but I see no reason why this should take more than 6 to 12 months. But let's see where that goes.
All right. And also, sir, in the last call, you mentioned that we have made some progress on procurement of Hydra product from the local sources. Would you like to comment more on that, or would you like to quantify more, that what proportion or how many number of pieces that you have contracted?
No, I would not. I mean, yes, there's progress, and we have been increasing our, local sourcing dramatically. But obviously, given the fact that I just mentioned earlier that we are not, we have actually had a lower sale in Hydra this year compared to last year. It obviously means that we've not been able to achieve the local sourcing to the level that we would have desired. So it's there and it's growing rapidly, but it's not where we need to be. And to be fair to the local ecosystem, we have to also mention that the Chinese ecosystem evolved over 20 years, and we can't expect that what somebody's done over 20 years, the local guys can do it in 12 months or 18 months. It's not a realistic expectation. It will happen, and it will happen, I would say, in the next year or two. I think there'll be enough local supply for this.
Fair enough, sir. Also, sir, on revenue and CapEx guidance, I think in Q1 we had mentioned that it will be difficult for us to reach 15-20% revenue growth in FY26. Now, given where we are in the first half, would you like to reinstate the guidance, or do we still see pressure on ground?
No, there's pressure because it's, again, like I said, it's a combination of two factors. One is on-ground demand, which is definitely better compared to Q1 at least. But our ability to supply this product category is still a day-to-day struggle and a day-to-day, let's say, it's every day is a new day. So that is what is keeping me away from giving you a change in my guidance. If we had ability to supply, I would definitely stick to that 15-20% over. We just have to see whether whether that last few months we can supply that quantity.
All right. And this last question, any CapEx guidance, sir, for FY26 as well as 27?
FY26 was Diana. We already gave our guidance for CapEx. For FY27, there's nothing further that I can speak of. Once it gets approved in board, then we'll discuss it at that stage.
Perfect. All right. Thank you so much.
Thank you.
Thank you. The next question is from the line of Vaidik Bafna from Monarch Networth Capital Limited. Please go ahead.
Congratulations, sir, on good set of numbers. Sir, I have questions in the opalware division. Sir, we constantly outperformed in the opalware category against the competition. So what different are we doing against the market leader, who was earlier the market leader? And in this quarter, did we have any institutional orders for the opalware? If yes, then can you quantify an approx figure?
To the best of my knowledge, we had no significant institutional orders at all this quarter.
Okay.
But I look, frankly speaking, the market is a market which is competitive in general, but we try and do what we are strong at, and I believe that we focus on our own areas where we feel that we can deliver reasonable product and growth for our customers as well as shareholders. So I would not like to comment on anybody else because the setup of our business is different. So not fair for me to comment on any competitor. And these things are a habit of changing, quarter to quarter. So frankly, I've not studied the numbers too much. I only look at our numbers, which we try and do better at. I hope we can continue growing, and I hope the industry grows, because without industry growth, our growth is not is on assured. So I do hope that the whole opalware category grows substantially in the years to come.
Got it, sir. And sir, secondly, on the glassware division, in this quarter, we've grown by more than 50%. So what has led to this growth, and what kind of growth trajectory are we looking at in the coming quarters and in the coming years for this division? And yeah, that's it. So this is the question.
As far as glassware is concerned, I think the reason for the growth is, and I think this was it's a thesis playing out, that when you give more choice to the customer, tends to buy products, more items. So I think the key to success has been the establishment of our plant. Like I said, it's the first of its kind in India, Borosil press product, and we have been able to grow that market by offering customers choices of products. As I've mentioned in my opening remarks, there is a clear shift from plastic to glass and to healthier alternatives, which we are seeing. And, we are kind of, I would say, we have some tailwinds over there. So I would say it's broadly a shift in consumer sentiment, accompanied by our ability to give the customer more choices, which has led to, better growth in glassware. And this was actually the thesis. So I'm glad to see it's playing out. We still have some weight. Glassware is still a very small percentage of, the whole kitchen and storage and even the lunch boxes. So I believe there's still a long way to grow in this area. So the work has just started, long way to go, and let's hope we can continue, switching customers away from plastic to this product category.
Got it, sir. And sir, out of the 90 to 93 crores of revenue in this quarter from the glassware division, how much would be from own manufacturing and some bit of outsourcing as well, right?
I think 90%. I don't have the number off the top of my head, but more than 90% will be our own manufacturing.
90% from own manufacturing.
Yeah.
Got it,
More
sir.
than.
So that's it from my side. Thank you.
Yeah. Okay, thank you.
Thank you. The next question is from the line of Akshat Mehta from Seven Rivers Holding. Please go ahead.
Thank you, sir. Just wanted to understand, earlier we were only going to put up 2 lines, and now we have approved for the third line in the stainless steel facility. What is the thought process behind adding another line in the market?
Because, as I said before, we were hoping that we'd get more local sourcing, but that's not working out to the level. Like I said, we are getting sourcing, but it's not as much as before. So we just thought, rather than be dependent on someone else, let us make more in-house. And that's simply the thought process, nothing else.
Okay. Also, sir, when can we see this? So I know because we have a lot of stainless steel inventory lying on our books. Can we see some of the inventory come down by end of the year or probably first half next year?
That inventory's already come down, but as somebody already asked before, unfortunately, it's going to be replaced by another inventory, which is our appliances inventory, which is also going into BIS this year. So yes, overall inventory of stainless steel is dramatically reduced by end of this financial year, or has already reduced substantially. But on the books, you may not see one more year, this year rather, much reduction in inventory. Next year, you should see a substantial reduction there.
Also, can you help us understand, there is some royalty income of 3.8 crores on the presentation. What is that regarding?
Yeah, Borosil as a brand, which belongs to Borosil Limited, and our, let's call it a group company, or I don't know what the technical term is, but Borosil Renewables uses that brand, and therefore they pay a royalty to Borosil Limited for usage of that brand.
Okay. Also, can you help us understand, exactly where we are in terms of, construction or, setting up of the stainless steel facility as well as the solar plant, which you said last call?
So I already said in the opening remarks, stainless steel facility, we expect production by Q4. Solar plant also, I think in the next couple of months, by maybe also Q4, we should start seeing some net metering, or some supply of energy from that plant. Maybe Feb, March. The first full quarter for both will be Q1 of next year.
Last one, sir. Can you share the shared support service income and expense number?
I think it's mentioned in the opening remarks. And Anand, or is anyone on the call who can share that number? Or Rajesh?
Yeah. So, sure. This quarter, this half, we have about 12 crores of shared support service income, and in the previous period, it was about 6 crore rupees.
This is 10%. 8 crores. This is lower 10%. Yeah.
Okay. And the expense number, sir?
10% lower.
10% lower, because we have a
10%.
cost plus 10% markup.
Okay. Okay. Thank you.
Thank you. The next question is from the line of Sumit as an individual investor. Please go ahead.
Good evening. I had three short questions. I'll make it quick. You have mentioned the pharma industry not enabling us to do gifting anymore. I presume that continues. My question was, when does this lap up? Which quarter will that base effect go away? That's my first question.
I think the base effect is gone.
So it's been more than a year now.
Yeah.
Okay, got it. Second question was on the competition from Milton Plastics and Opalware. I'm not sure where that is coming from, and I know you don't comment on competition, but do you envisage an effect on margins or some pricing pressure coming forward for the Opalware division because of that?
I don't think so. Milton's a very, I would say, well-established player with very good distribution. And in many cases, our distribution doesn't actually overlap. So, and they're a very mature and seasoned, I would say, company. So I don't see that margin. They will be doing anything to upset the industry structure from a margin perspective. That's my sense. But it's early days, so we'll see how that goes. But I'm not seeing that, and I don't think we'll see that also going forward.
Wonderful, wonderful. And the last question was that the BIS coming for the appliances. So just like we were kind of caught, I shouldn't say unprepared, but off guard in terms of the Hydra, that we thought there would be local sourcing, and then we changed tack and got it in-house. The same situation may again occur in appliances. So do you have any plans for doing some manufacturing in-house, or at least on a subset of the lines which are your fastest selling? Any plans on manufacturing therefore in-house for appliances due to BIS?
So that's a good question. I think there's two things that are different compared to Hydra. One is that as we speak already in appliances, 50% of that is made in India, okay? Compared to in the case of Hydra, 100% was being imported. So in that sense, we have a 50% head start on appliances already. And what we do see is another 20-30% is well within our reach to execute local manufacturing before the let's say, implementation of BIS. So there will be some gaps in certain SKUs which don't have an Indian ecosystem. And we are doing the cost benefit at the moment to see whether it makes sense to manufacture those or just lose those SKUs altogether. So that work is going on. And we will definitely, having learned from Hydra, we'll definitely not repeat that with appliances, in the sense that we will, before the time is up, either invest or set up local sourcing, which is well proven before the BIS fully kicks in, or we start getting impacted in revenue terms from it.
Got it. Thank you so much. All the best.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management. Over to you, sir.
Yeah, well, thanks everyone for your engaging questions, and reflects to me at least that people are interested in our organization and how we're doing and what we're doing. So thank you for your engagement once again, and I look forward to sharing the updates for you for the next quarter.
On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.